Hi everybody, this is Ellman, the Blue Collar Investor, with today's covered call writing question of the day, which comes from Mike. Alan, would you consider using the BCI method with stocks that have poor fundamentals? I purchased Facebook from our running list and it took a big hit after a disappointing earnings report. I am now at a break even with the stock, not counting my option premium profits. There were many positives in the report that give me a bullish outlook. I can continue to sell options or allow assignment. Any thoughts are appreciated, Mike. Well, Mike, absolutely. What you're talking about here is a stock that you love for the long term. You're bullish on it for the long term, and you want to enhance your returns by selling covered calls. We refer to this as portfolio overwriting in our books, DVDs, and blog articles. So absolutely. So before we get into how we go about doing this, and specifically with Facebook at this point in time, let's review the current status of Mike's position. Based on the fact that Mike sent me this email on a day when Facebook was trading at about 119, and he said that he's at a break even, we're going to make the assumption that Mike purchased his Facebook shares at 119, the current market value. Now, over the past few months, Mike stated that he had generated several months of premium, and good for you, Mike, for doing that. Now, the earnings report caused a big hit in the share price, and as we all know, avoiding earnings reports is one of the golden rules of the BCI methodology. That doesn't mean you can't hang on to the stock through the report. If you're willing to take that risk, then you could do so, but it doesn't make sense to sell the option, cap the upside but not the downside of potentially a gap up or a gap down in share price. Now, Mike is still bullish on Facebook based on other aspects of the earnings report, and so he plans to hold on to Facebook long term. And the question is, do we continue writing calls or sell the stock or allow assignment, as Mike stated in his question? So let's first kind of get a frame of reference as to what Facebook has been doing over the past year by looking at the technical chart slightly after the decline in share price. And here you have on the screenshot showing that Facebook was having just a phenomenal year up until the point of the earnings report, where you see that a very serious gap down in price. Now, shortly after that, highlighted by the second arrow, you see that there was a moving average crossover. That means that the short-term moving average, which was all along higher than the longer-term moving average, something we like, actually declined below the long-term moving average, a very bearish signal. And since that point in time, Facebook has been trading sideways to slightly down. So just from a technical perspective, we would never use a stock like this in our covered call writing portfolio. However, this is an exception because Mike is bullish on the stock and he's using a covered call writing like strategy, portfolio overwriting. So he likes it long term and he's going to hang on to it long term. So we're going to increase those returns by selling covered calls. So the first thing we want to do when we're doing portfolio overwriting is to look at an options chain, and specifically the out of the money strikes. And why do I say that? Because out of the money strikes will generate for us time value premium, which is what we want with covered call writing, but also allow us to take advantage of share appreciation from current market value up to the strike. And since one of the reasons that we're using this strategy is that we're long-term bullish, we're going to allow for that share appreciation. So we're going to look at an options chain, specifically out of the money strike. So here we go. The next screenshot does show that. At the time that I made this, produced this video, you could see that Facebook was trading at 118.83. So we're going to look at strikes ranging from 119, very, very slightly out of the money, up to the 122, which is much deeper out of the money. You could see the premiums range from 251 to 204 to 163, the lowest 129. So the deeper out of the money we go, the lower the option premium that we're going to generate. And that pretty much goes for any options change. The deeper out of the money you go, the lower the time value returns. So what we do is we take this information, we feed it into the multiple tab of the Ellman Calculator, and on this next screenshot we could see the results. And on the third column from the right, we see the return on the option, the initial return. These are 1 month returns, and we could see that those returns range from 2.1% down to 1.1%. So the deeper out of the money we go, the lower the initial return. However, upside potential, which means share appreciation from current market value up to the strike, runs the opposite direction. It's lowest for the 119 strike and highest for the 122 strike. So the deeper out of the money we go, the more opportunity we have to take advantage of share appreciation. So the 1 month return potential ranges at the top from 2.2% at the 119 strike down to the deepest out of the money strike that we're looking at, the 122, which has a potential 1 month return of 3.8%. What all this means is the more bullish we are on the stock over the next month, the deeper out of the money we should go with the out of the money strike. All right, so there you have it. Using out of the money strikes on stocks that we're holding for the long term, that's portfolio overriding. So let's summarize. And the summary is that stocks that we're bullish on long term can be used for covered call writing, even if they have poor technicals at certain points in time. We are committed to these stocks. This is known as portfolio overriding, and we always favor out of the money strikes when we're using portfolio overriding, and the deeper out of the money strikes are favored, the more bullish we are. And that's usually based on overall market assessment and current chart technicals and other information like that. So Mike, there you have it, a very important question, because we have many members that use covered call writing on stocks that they already own, stocks they want to keep in their portfolio, stocks that they are long-term bullish on. And this is how we approach it, portfolio overriding. There's a lot more information on portfolio overriding. Both complete encyclopedias, chapter 14 is dedicated to portfolio overriding. So if you have those books, check out chapter 14 again and review some of the information that I have provided for you relating to this strategy. So Mike, thank you very, very much for this very important question. Appreciate it. And of course, thanks to everybody out there for taking the time to watch this video. Hope you enjoyed it. And most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.